Hello, everyone. Welcome to the special edition Pepper podcast entitled All the Moving Parts. What do they mean for you? We are recording this podcast with senior members of Pepper's marketplace lending practice before they head off to LendIt USA 2016 in San Francisco. Joining me today in Philadelphia is Pepper partner Julie Corelli. On the phone in our New York office is partner Greg Novak, and also on the phone from our Wilmington, Delaware office, partner Rick Ekman. There's a lot to cover about developments in the marketplace lending industry, so let's get started. I will try to direct questions to a specific person, but everyone feel free to jump in on any question. Rick, let's start with you because the Madden case has been in the news quite a bit lately. What are the latest developments?
Well, thanks, Brian. Well, we've been following the Madden case very carefully and pretty comprehensively since it was decided almost a year ago. And I think the reason is, because our clients are very much concerned about its implications. And so we have quite a few alerts that we put out, and I would recommend people to visit our website and take a look at them if they want to have our take on what Madden is all about. The latest development is that on March 18th, the Supreme Court met in its Friday office conference where it decides on whether or not to accept cases for cert. Cert petition had been filed last November by the defendants who had lost at the Second Circuit. And we were hopeful that we would have a decision as to whether or not the Supreme Court would grant cert as a result of that office conference. Instead, they did something which is not unprecedented, but it's a little bit unusual. They asked the Solicitor General to weigh in on what was the position of the United States government with respect to this case. And the Solicitor General represents the United States government in all of its cases in front of the Supreme Court. And by asking them to file a brief, which will be due, I think, sometime in mid-May, usually it's a 60, I believe the rule is that they're required to be filed 60 days after the request is made, so that would be around on or about May 18th. And what will happen is the Solicitor General will poll the various branches of government to see what their take is on this case and what position the United States should have. I think what this does is really politicize the process because, there are lots of folks out there who believe, that Madden is really a consumer case because it's a debt buyer who is trying to collect, money, from a consumer and increase the interest rate, up to, I think it was 26 or 27% above the 25% New York, criminal usury statute. And so if you look at this as a consumer case, then you're going to get some very interesting competing views within the government as to, whether this case was rightly decided or whether the Supreme Court should take a look at it. You have the OCC, which is the protector, if you will, of national banks. They have traditionally been very, very strong in terms of trying to enhance the charter of a national bank. Particularly, before this administration, quite frankly, they took a very strong position as to preemption. The Dodd-Frank Act really tried to pare that back, but didn't do much other than trying to change some of the procedures that the OCC goes through in terms of preemption. But the OCC has not weighed in on this case at all. It did not file an amicus brief at the Second Circuit. It did not file an amicus brief in front of the Supreme Court, as 12 other entities did. So they have remained silent on this. I don't believe that Comptroller Curry has said a word about the Madden case. It's interesting that they recently came out with their innovation white paper last week. Some would argue that, Madden really puts a damper on the whole marketplace, industry, particularly obviously those that, are collaborating with banks to be able to offer their products, throughout 50 states and not have to worry about state usury limitations. So you have the OCC is certainly going to be a player, and then you have the CFPB, I suspect, will weigh in. And I think it's pretty clear as to what position they would take. I mean, their sole goal in life is to protect consumers. And so they don't really care at all about, safety and soundness or, the value of the national charter. So I think you're going to see some interesting developments, and it's going to be fascinating in my mind to see what position the Obama administration takes on this. I actually just got an email last week from one of our trade association clients that we work very closely with, and they wanted to know, what position we thought the trade association takes. So there's, as I said, this has become a political issue because all the trade associations in Washington are going to weigh in. I wouldn't be surprised if you had someone on Capitol Hill that would weigh into this. So it's going to be very interesting to see, how this all plays out. But once again, we're not going to know whether the Supreme Court accepts cert until the middle of May. If they would accept cert, then they're going to have to put that up for argument clearly in the next term. And so we probably won't get a decision for another year. So again, it's further uncertainty in the marketplace lending area with respect to the impact of Madden.
Hey, Rick, this is Greg. Isn't this contrary to at least 100 years of precedent from the Supreme Court saying that loans, when issued, are valid at inception, continue to be valid?
It does. There was a case back in, I think it was 1838, something like that. So it's not 200 years old, but it's 175. And that was really the first case that that espoused or accepted the valid at inception rule. And back then, it was banks trading, commercial loans. I think in that case it was like the Kentucky, and I may have the states wrong, maybe it was the Tennessee bank was sold a loan to a bank in Kentucky, and the borrower said, hey, your loan now is is held by a Kentucky bank, and therefore you're subject to the Kentucky usury laws, and guess what? This loan is invalid. And so that was the first case that the Supreme Court really ruled that, we're not going to worry about what happens to the loan after it is sold, because it's important, for our interstate commerce and just the free flow of dollars in our country, that banks should be able to, sell loans and not have to worry about what the character, that the character of the loan is going to change as a result of the sale.
So if you take as a given that the Second Circuit was not going to be presumptuous and try to overturn Supreme Court's precedent, which of course they have no authority to do, then there has to be some other rationale for why they thought that this loan was not subject to that ancient precedent. Is it? Well,
yeah, I think they were certainly well aware. I think all of us thought, well, when they first looked at the case, they didn't have the right lawyers arguing the case, some people said, and, they didn't really understand the implications. But then, when there was that petition for rehearing en banc, you had a bunch of, very well-regarded, trade associations, American Bankers Association, the LSTA, the New York Clearinghouse. They all weighed in and say, hey, this is a big problem if you're not going to recognize the valid at inception rule. But I've always viewed, and others that other commentators, other lawyers have taken a look at this case, and I think it is distinguishable in the sense that you had a credit card loan that was charging, I assume, something around, let's say, 18%. It was sold by a bank to the debt buyer, and the debt buyer, raised the interest rate to 27 or 28%, which was the default interest rate, and that was done after the loan was sold.
So isn't that the issue right there, that the debt buyer, not a national bank, had modified the loan and, in effect, reissued the loan, and so therefore you could argue that it wasn't valid at inception at the time?
Well, I think the problem with that is that, they had the right. It's a question, I guess, of what the valid at inception rule really means. In an installment loan or a closed-end loan, commercial loan, you have an interest rate, that's set when the loan is made, and then the loan is sold, and, you get to continue to charge that rate, which would be most of many, I guess probably you could say most of your marketplace lending deals with closed-end, installment loans. Not too many deal with open-end loans. But, in this case, you had a debt buyer who had and they made a big deal about this, had no relationship with a bank. He wasn't their agent national bank, or is the rule that, you only can take the interest rate, that you're given when you acquire the loan. So to me, there are a number of ways that a court, if in that case is not accepted for cert, that this case could be distinguished, and that clearly is distinguishable. I mean, there hasn't been any other cases that I know of, that have weighed in on this issue. I'm certainly sure we're going to see some in the future, but, it'll be fascinating to see what the government does in terms of what its position is, because it could clearly say, we think the Second Circuit is right. And then I think there's probably zero chance that if that's the case, that the Supreme Court will accept cert. So I think that this development is very critical to the future of this case. And it'll be fascinating to see if we ever get to take the inside look or get the inside look as to what the government's process was. I think it'll be fascinating to see how that position has been developed.
But it's unlikely that the solicitor is going to prepare a brief that says, well, the OCC says this, but the CFPB says that, and the SEC says that. Is it? I mean, will they take, a neutral position because the agencies are warring over the issue?
Well, that's I don't know, quite frankly, enough about how the Solicitor General works. That's not my practice area, but I think they are going to espouse a position which is going to reflect the government's position on this case, and I would be surprised if they, didn't come down one way or the other on the case, because it's really, in actuality, my understanding is that it's a request by the Supreme Court, to ask if the Solicitor General would, in fact, provide its position. They're not required to, but I don't know if they ever not done that. So I think it's something that they will come down very clearly one way or the other, and will not take a middle road, because that really is their function. I mean, they want to know. I mean, the justices have asked, what is the position of the United States? We have all these amici that have said, have told us that this, case is the end of the world in terms of, securitization and, other, traditional, bank kind of, financial transactions. And is that true? I mean, is that the position that you think that's going to really happen? So I think the biggest, of most interest is going to be the OCC's position, because they have been sort of remarkably silent on this issue. And again, I think they view this as a consumer case, and since 2008, the consumer has reigned as the king of Washington. If you look at the development of the CFPB and everything, I mean, everything that in Washington has a consumer protection bent to it these days.
From a practical standpoint in the market, the wait and see approach is still what we see, at least on my end, is going to be the MO for most of the marketplace lender clients. They're watching it carefully and trying to gauge how it might come out, but have you seen people actually change their practices in how they're structuring their loans?
Well, you had the recent press release, and then the public filing by Lending Club, in which they renegotiated their relationship with WebBank, which is their bank that actually originates all of Lending Club's loans. And what they did was they did two things to deal, in my mind, with Madden and perhaps the true lender issue. One was they came up with this concept of a borrower account. And the borrower account is owned by WebBank, and it's defined as really the relationship, if you will, between the borrower and the bank, and the fact that the borrower has taken out a loan and they, in fact, take out another loan. So it's really that customer relationship that they, quote-unquote, own. And then at the end of the contract, Lending Club has the right to purchase that relationship for an undisclosed amount of money. So it clearly is viewed by the parties as having a value. And the other really tied to the performance of the loan on an ongoing basis, and so they have some continuing skin in the game, if you will, in terms of the performance of that particular loan. So I think that is a helpful change, if you will, in the relationship, a helpful change in the fact pattern, and gives them a better argument, if you will, that Madden does not apply because the loan, the entire, all the aspects of the loan have not really been sold, and that the bank has a continuing interest in the performance of that loan. So there's a relationship that is continuing. It's not just a total assignment of all right and title and interest of the loan, but there is some retained interest, if you will, and sort of a total bundle of rights, to borrow a concept from real estate law. So there's a retained, some retained rights that they have in that particular loan. So that's the one that I'm aware of recently, and I think it's hard not to argue that that's in response to Matt, because Lending Club's stock price has suffered, and some think it's a result of sort of the hangover, if you will, or the overhang of the Madden case. And the other thing that I see, and I counsel clients on, is the relationship of between a bank and a marketplace lender is not as strong from a legal standpoint as one would like to have it be, because of the true lender issue, as well as Matt meant. So I believe that a stronger business model is going to the state licensing model, because to me that one gives you certainty in terms of your legal position. You know exactly what interest rates you can charge, but that does not obviously come without increased compliance costs. Trying to get licensed in all 50 states is a daunting proposition. It takes you many months to do that, and then you're rewarded with having 50 state regulators come in once a year to examine you. So you pretty much have to develop a full-time compliance staff to do that, which is very difficult for smaller startups to take that on. So that's what I see. But I think you're right. I still think it's a wait and see kind of situation. I mean, the Second Circuit only involves 3 states in particular. You can look at the interest rates that you're charging and adjust them, for states where they would be problematic. So a lot of ways around it, but it definitely has the attention of the marketplace lending community still.
Greg, let me turn to you. Are there any developments in the creation of a secondary market?
Well, there's a lot of noise in the marketplace right now that, quote unquote, there are people, close quote, working on creating a secondary market. And yes, I would say that there is most definitely activity. But before we go too far into this, keep in mind that there are already secondary market sales and purchases being done through the Folio FN platform. So that does exist presently. The other thing to keep in mind is that securitizations are a form of secondary market where an entire pool of loans is sold into one purchaser and thus providing liquidity. But what we don't have is a NASDAQ or similar type relationship where you could go and get a quote on a particular loan or a portion of a loan that you hold and then sell it. There have been a couple of roadblocks causing that to take longer to develop than I think most people had hoped. The first is, if you think of NASDAQ or the New York Stock Exchange, there is a repository where all of the evidence of ownership is held, namely DTCC, which was a consortium created by the exchanges and brokerage houses to facilitate the electronic transfer of these types of instruments. So there is no comparable thing for marketplace loans, and most of the loans are held in the custodians by the two largest platforms or any of the other platforms that are created. So there was this issue about how do I actually move the paper. Now, probably the most promising development that we're hearing about is blockchain. Most people know of blockchain as the basis of Bitcoin, but blockchain is a much more powerful tool, and essentially it's a distributed ledger technology that allows investors to, or not investors, but party participants to the blockchain to have, for certain, a completed transaction or evidence of a transaction in one digital file. So the best analog you can think of is either a self-proving will, where because the parties have, followed the formalities and it's notarized, you don't have to look behind the piece of paper that you have in front of you, or a certified bank check, where you know that, or a letter of credit under the Uniform Commercial Code, where the presentation of either the certified check or the letter of credit is going to require payment unless you get a court order to stop it. Blockchain presents the possibility of creating a very similar mechanism. So if you envision a loan being created by a peer-to-peer platform and using the current origination, but then all of the features of the loan, the ACH payments, the security, if any, the identity of the borrower, is all then put into the blockchain, and then that becomes the embodiment of the loan. Now it's a lot easier to move that around. You don't need a quote-unquote custodian to actually move that piece of paper. It could simply move through the internet. Now, whether or not everybody can get comfortable legally that that's okay and that it's enforceable is a different question. We may need legislation, but at least we're hearing people working on the blockchain solution to the DTC problem. The other issue that you have is a fundamental one. It goes back at least 70 years, and that is a loan a security? And now, participants who work from the banking side will tell you in no uncertain terms that a loan is not a security. Participants who come in from the 40 Act side for funds will tell you absolutely it is an investment contract, and it should be treated as if it were a security, even though definitionally it may not be a security. And so the question becomes, if I'm transferring this thing, do I need to be a broker-dealer? Because if it's a security, I do. And if it's not a security, I don't. And that is an age-old question, and most of the participants in the space who are trying to create secondary markets have erred on the side of deeming it to be a security, and therefore have gone through the process of setting up or buying broker-dealers that have the competency to do this. And then the last piece that has caused this problem is, even if you say it's a entity or an instrument that should be treated as if it were security, and I've got a custodian, and I've got a broker-dealer, the last problem is the piece of paper itself hasn't been registered. If you think of securities that are traded on a stock exchange, they're all registered securities under the Securities Act of 1933. These instruments that we're talking about here are not. They are all private placement instruments. So if they are securities, you now have a 33 Act problem. How do I transfer this without the benefit of a registration? And if somebody acts as the facilitator and there's no registration statement, are they now duty-bound as an underwriter to create a registration statement? So the glimmer of hope that we've had there actually came out of the Surface Transportation Bill last December, where Congress has finally legislated the creation of what used to be a judge-made rule, the so-called 4.1.5 exception to registration under the Securities Act, which has now been actually adopted and is part of Section 4 of the 33 Act. So now you can have a secondary market transfer of a security under Regulation D, if you will, as long as the parties to the transaction are accredited investors. So what we've now seen, if you start putting the pieces of the puzzle together, is the 33 Act modification from the Surface Transportation Act now alleviates one of the last roadblocks. The technology presumably is going to solve the custody and the transfer issue, and now we have the issue of the broker-dealer which takes time. It takes easily 6 months to set one up and 4 or 5 months to buy one because you have to do a change of control application, is slowly but surely solving that issue. So then let's assume all those legal issues have now been resolved. The question is, what does this thing look like? And for the most part, an automatic bulletin board where you click on something and it automatically changes control from one account to the other is still probably several years away. But what you may have is more of an eBay type thing where you have the bidding on the list that at least identifies who the buyer and the sellers are and a price. So you have a price discovery mechanism. But then the actual fulfillment, the transfer, will happen offline, much in the same way when you buy something on eBay, it says to complete this transaction, click here, and that's where you identify payment processes and the actual transfer. So still a lot of work to do in this particular entity. I don't know if there's a first mover advantage here. There may be, but there certainly are still large number of legal issues that need to be resolved, as well as practical business issues before the secondary market hits the marketplace. Right now, if you were to go on Folio and look at some secondary loans, most of them are being listed at premiums, which kind of begs the question of whether or not you can ever get a premium rate for this, primarily because the reason why they're listed as premiums is because the embedded interest rate is so much higher than what you'd see in the marketplace. But the reason why it's higher is these loans tend to have a lot of risk. So, that's a long answer to a very complicated question, but there clearly is movement and pieces of the puzzle are slowly falling into place as time goes on.
Thanks, Greg. Is 506C under Regulation D being utilized by the marketplace lending community?
Well, the answer is yes and no. The answer is no, because in order to do a 506C, you actually have to check a box and file a Form D. Certainly the large issuers of these things tend to issue registered securities if they're issuing fractional loans or borrower payment dependent notes. If they're issuing whole loans, they're in private placement transactions, usually with well accredited investors, so probably not a general solicitation there. However, from a practical point of view, if someone is running a fund and they are trying to gather investors, they may by default have tripped the 506C requirements because they're not paying careful attention to the old 506B rules. And it's very important that people realize if you want to do a private placement and you don't want to confirm that your investors are accredited investors, then you have to do a 506B, and that means you are only going to so-called friends and family, people that you know and know well enough so that you know that in the event that there is a loss in the investment, you won't destroy their lifestyle. That's sort of a long-winded explanation of the friends and family test, if you will. But you can't have a general solicitation. You can't have websites. You can't have open solicitation or delivery of investment material concerning the security that you're selling. If you are using an open website, then by default you've probably triggered 506B, but you haven't realized it. And so it's one of those things that oftentimes sneaks up on you. It's a very powerful tool, but it means that you have to have limited your offerings to accredited investors and confirm those, and or not offerings rather, but sales to accredited investors and confirm their status. And often firms are unwilling to get tax returns or otherwise confirm status. So the answer, as I said, is de jure, probably no. De facto, probably yes.
And just for our audience, a quick reminder on 506B and C, as Greg was saying, the B rules require that you can't go through a general solicitation or advertising. So putting it on your website would be an advertisement that would throw you out of 506B. And the only recourse then is to comply with 506C, which was adopted in September 2013, I believe it was. the final rules came into play, and it was very slow uptake in the general offering marketplace lending aside. It was used by a number of real estate platform companies, and rather successfully, to raise money to invest in real estate. And it has been used by a number of operating companies, but not so much to raise money to fund loans. That's been much more the institutional investor. But the operating platforms have used 506C. And as Greg said, it will allow you to, with certain conditions being met, to raise money much more openly, not just go to the friends and family, which is a term of art for people with whom you have a pre-existing relationship. There was a no-action letter that came out just a few months ago that was pretty helpful, capital VC, in terms of defining when and how you might have a process to have a pre-existing relationship with somebody, which was something of an acknowledgement out of the SEC that times have changed and technology has changed the way people get together and get to know each other. But it was not a roadmap for how you could use technology to substitute for creating a pre-existing relationship. So there's been a lot of developments in 506B and C as you get into proving that accredited status. You find yourself with rather sensitive information that you have to maintain to prove that you actually did verify someone's status as an accredited investor, and you have to retain that information if you're an advisor until the 6th year after you've actually raised that money. So it's a lot of privacy concerns. It's a lot of data management concerns to use 506C. So it's not surprising that people have been slow on the uptake to utilize it. You do still have to file the Form D, as Greg said, and that puts your information, or at least some of it, of public notice, whether you do a 506C or a 506B. So there's a lot to think about before you jump into that hoop, and you do end up seeing people, when you're on our line of work, you see people who inadvertently jump into that hoop and then have to manage their way through it. You can go from B to C, but you can't go from C to B. So there's a fair amount of planning that has to occur in your offering process before you jump into the fray.
Although, interestingly enough, on that last point, going from C to B, we actually had a situation where someone checked the box that they were 506C, but then they never sold anything. So they never had any investors come in. And we're now trying to uncheck that box, if you will, and go back to a B.
As long as they didn't do the general solicitation and advertising in the meantime, or they had a sufficient cooling off period between their change in plans, that certainly can work. You're right.
Thanks, Greg. Thanks, Julie. Rick, let's turn back to you. What role do you see the CFPB playing in regulating marketplace lending?
Well, I think you're going to see they certainly have a great interest in playing a role in the small business lending aspect of marketplace lending. They currently have jurisdiction over most financial services companies, and so that offer consumer loans, and so they clearly have the ability to go in and send out civil investigative demands if they think there's a practice that is unfair, deceptive, or abusive. They could file lawsuits. I mean, there's a lot of things they could do to protect consumers in that marketplace. The big news is, though, that they just recently announced that they are now accepting complaints from online lenders in their complaint portal, and that is a creature of the Dodd-Frank Act of Title 10 that set up the CFPB, and it's been a primary way that the CFPB keeps its pulse on the marketplace. And they have portals now for mortgages and credit cards and student loans, and so they just announced that they were setting one up for that is going to be sort of the first foray, if you will, into the regulation of marketplace lenders, or at least for them to have a window on what the consumer's participation is and whether it's favorable or not. And they use those complaints as a tool to focus on industry practices or on particular companies that have a large volume of complaints. So one of the key things that we advise clients is to pay a lot of attention to that and treat your customers well. Get back to them and resolve their issues, as best you can, because it's very easy for them to get online and make a complaint to the CFPB, and that's not going to be something that you want to have stand out. A couple of other things that they're going to be doing in the future. Section 1071 of the CFPB statute requires them to come up with a rule that would require HMDA-like reporting with respect to the kinds of borrowers, the makeup of borrowers that are receiving loans and not receiving loans in the small business space. HMDA is a law, for those of you who don't know it, the Home Mortgage Disclosure Act, which requires mortgage lenders to report on the ethnicity of the borrower that's receiving the loan, and they use that data to ferret out instances of discrimination. And so that same type of reporting is going to be required for all small business lenders once the rule actually, or the regulations are issued. The rule actually went into effect, I think, on July 21st of 2011 when the CFPB was established. But it's a very complicated rule, and they have had other things to focus their attention on over the last almost 5 years now. So we're going to see them start the process of getting that rule together, I would think, sometime this year, if you believe what they say in their advanced agenda of regulations. And they're looking for a small business director, if you will, assistant director, I believe, to oversee that whole process, because they're clearly interested in small business. One of the things that concerns me the most is the view in government, and I say that very broadly, whether it's the Treasury Department or the CFPB, where they view small business as really just consumers that happen to be engaged in some business activity. I've heard that on more than one occasion. So that's how they're viewing this space. And there's always been a very clear divide in the Consumer Financial Services law between a business loan and a non-business loan. And it's a very, sort of bright line test, if you will. But I think that's being blurred now based upon sort of this development and others. So I think you are going to see some more focus. But down the road, they are going to come out with what we call a larger participant rule. That's one of the categories of industries or of types of industries in the financial services space that they can regulate. And that's going to be directed at installment lenders. So you could certainly see a day where Lending Club and Prosper and the other larger installment lenders are going to be supervised by the CFPB and examined by them as well. So stay tuned for this, but the process is certainly playing out that the CFPB intends to be a very active player in the marketplace lending space.
And Rick, you mentioned this earlier, but I wanted to circle back. What are the advantages and disadvantages of the bank versus state licensing models?
Well, clearly the bank model gives you the ability to export interest rates throughout the United States under the Marquette decision, and that is a very powerful tool for any lender to have. I mean, when you have to worry about 50 different state laws in terms of making a loan, I mean, that's a daunting task. So that's the primary reason that there's this, I call it a collaboration as opposed to a partnership between a marketplace lender and a bank. And so that's primarily how it's just a way for them to operate that's the primary benefit of that, and why a lot of your larger players choose that structure. But we have many clients that are using a state-by-state licensing model, and depending upon your interest rate, you'd be surprised that a lot of states don't regulate you and don't require you to actually have a license if you're not charging a rate that in many states, let's say, is 12%. So, in many cases, student lenders in particular, charge very low rates, primarily because student loans are not dischargeable in bankruptcy, so that risk is pretty much eliminated, not totally eliminated, pretty much eliminated. And so, depending upon your product mix and what kind of loans you want to make, that's really, part of the analysis that we go through in terms of making a recommendation on what's the rate structure for this particular client.
Julie, what is the impact of the retention rule for banks, and in your view, is it sustainable?
Well, that's a loaded question. The retention rule is relatively new in its developments in marketplace lending, but it originates way back in 2009 and 10, and the development of all the rules that came and culminated in Dodd-Frank. It relates to the season and sell structure of many of the marketplace lending loans, and now it's season and sell 95% instead of season and sell 100%. Definitely has an impact on the true lender analysis. So there's a lot of legal implications to the retention rule. It also gets wrapped up in the discussion about what is systemically significant financial institutions. And it's really a means for the government to prevent systemic risk as opposed to measuring it and monitoring it after the fact. So all of those policies and philosophies aside, the real practical impact is that 5% of the loans a bank writes will need to stay on its own balance sheet, one way or the other. There is a lot of discussion over creatively structuring to manage that, whether you can have credit risk protections put in place, like credit defaults or securitizations. All of those things go into the bank managing that risk. If it's pure and simple, you look at it that way, then it's 5% and it creates additional capital requirement for the bank to be involved in this line of business. And eventually, as portfolios of loans grow, that 5% would grow and it becomes a bigger capital obligation of the bank. As loans get repaid, that 5% is on a smaller pie, and maybe that provides cash flow to the bank that they can rewrite additional loans. So there's a lot of cash flow implications for the bank. There is a lot of capital needs implications for the bank. But from a standpoint of the marketplace lending community, it's here to stay, and it keeps the bank with skin in the game so that we don't have another subprime type lending arrangement like we had 10 years ago now.
Thanks, Julie. Greg, let's turn back to you in New York. Many managers charge acquisition fees. Do I need to be a broker-dealer to accept those fees?
Well, that's actually a very interesting question, and at first blush, when you look at it, the uninitiated would reflexively say, oh, that's a commission. But it isn't really. If you go back to the legislative history for when the Advisors Act and the Investment Company Act were first adopted way back in the 1940s, the legislative history is from the 1930s, it was clear that investment managers could charge their fees on any basis. So the most common at the time was hourly, and the new kid on the block at the time was the so-called assets under management fee. But since that time, assets under management fees have become the norm. There are very, very few managers who will manage a portfolio based on time. And then we have this latest innovation over the last 15 years or so, the performance fee or the performance allocation, where you get a share of profit. And that was only allowed when the SEC adopted an exemptive rule under the Advisors Act that allows for funds that have so-called qualified clients in them, qualified client or better, to be able to take a performance fee. So if you do research in the literature, Thomas Lemke's book and others, they're clear that an advisor is free to set any type of compensation arrangement, provided it's fully disclosed and provided it's not otherwise prohibited. So if I take an acquisition fee and you break that down, basically what you're saying is because these investments do not have a secondary market, or at least at the moment they don't, and there really is no liquidity, for me to charge 2% of assets under management like a hedge fund manager would or a private equity manager sort of is, arguably too much for the services being rendered, because if you think of the investment advisor function as a buy, sell, and hold decision, the one leg of it, the sell decision, is just not present because there's really no way efficiently to sell the portfolio. You could do it, as we said earlier, through securitizations and other things, but there is no robust secondary market. So everything comes down to the decision on when and how and what to buy. So if you then say, okay, I still have to monitor the portfolio, I still have to make sure that the servicer is collecting on the loans, I still have to oversee the custodyship and make sure that dollars are being paid out to investors. So there is still a fairly robust function to be paid by the manager, but maybe it's fairer to the investor to just charge the investor when the investor is actually receiving the service for the investment decision. And that would be when there is cash and that cash gets deployed. And so that's the rationale that what we've done is fully disclose a fee arrangement where I'm not acting on an agency basis like a broker-dealer. I am not finding a buyer. I am advising my client on what to buy and then completing the trade, which is what an investment advisor does, on a quote-unquote fairer basis than I would if I just charged 2% of assets under management for as long as the fund is in place. Even with waivers, this is still probably a better deal for the investors. So again, a long way of saying that the issue is not free from doubt, but there are legal and policy rationales to support charging a fee other than on an assets under management basis.
Well, if I advise people on which loans to buy, do I need to register as an advisor? And what if I say I'm just a technology company?
Well, that's a very interesting question. Unfortunately, we don't have the Technology Exchange Commission in place. We have the Securities Exchange Commission, and that goes back to that old age question: are marketplace loans securities, or are they something else? And certainly for the issuer of a security, the issuer of a loan, the person who actually signs the note, they haven't issued a security because they're not in a trader business. But when someone buys them, it's always been the SEC's position that a purchase of a note receivable, the purchase of a warehouse receivable, the purchase of any type of financial instrument like that looks like you are making an investment contract, especially if there's management by a third party of the profitability on the investment. So that would suggest that this is an investment contract which the SEC treats as a security. So do I need an investment advisor? Certainly, if I am advising people on purchasing and selling the registered securities that are issued by Prosper and Lending Club and some of the other platforms, I think there you probably do need to have a registered investment advisory license. If you are buying whole loans, maybe not. Depends on how aggressive you are, but certainly the conservative view would be that you should be registered as an advisor.
Great. Now, this has been a long discussion on a number of interesting developments. I wanted to thank all three of you for joining us today. For our audience, if you're listening to this and going to LendIt on April 11th or 12th, this Pepper team will be at booth number 819, and I would encourage you to stop by if you wanted to talk about anything further. And to anyone listening, please feel free to reach out directly to any of these Peppers if you want to talk about these topics further. Their contact information is easily found on their bio pages on our website at www.pepperlaw.com. Thanks, everyone.